All right, this is being recorded. One thing I mentioned at the beginning of all these about the recording is watch it again relatively soon after. Even if you are an options trader, I'm going to be talking about different things that you can't really find online. So watch it again so some of these nuances will really stick into your long-term memory. If you watch it a month later, it's going to be like learning it all over again. So I always recommend watching it over again, no matter what level you are. And this is beginner to intermediates, but even advanced guys, I think, are going to learn something new here. So, keep with those questions, and I'll try and get everything cleared up as we go along. It's pretty relatively easy strategy, the long strangle. It's similar to the straddle, except it's a little bit less risk in the sense of how much you have to put out for paying for this strategy. But probabilities might be a little bit smaller in some regards. All right, a couple of things to get out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. For my commentary on everything from economic to geopolitical and market analysis. I've actually been trading since college. My sophomore year in college, I started trading with some money I'd earned in high school. And from there, I switched my degree from psychology to finance, and probably still think that my psychology degree was probably better suited for trading than my financial degree, to be quite honest. Anyway, after graduating from college with a finance degree, I moved straight up to Chicago. A buddy of mine actually was sitting at a bar in college with me, and he was like, I just got back from an internship up at the Chicago Board of Trade, and he goes, Eric, this job is perfect for you. So I was like, all right, and literally packed up my bags, drove up to Chicago, walked around on the floor, and got a job. So I started out as a little runner that was running around handing paper up, sold all my stocks, bought myself a badge, and jumped in the pits and started trading. Please take a second to go over this disclaimer. It's really important, you guys. At the end of the day, what this is saying is the reason why I can't give you a recommendation, like go out and buy Google or Amazon or short Tesla and all of those things that I may have in my own mind as to where I think value is and where I think the direction is. But that doesn't take into account what's already into your portfolios and what's already or what your risk parameters are. None of that stuff is taken into consideration when I'm doing my trades. So take what we teach you here, implement it into your portfolios in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. And if you're one of our premium members, please, I know a lot of you guys, Ted's out there, Mary's out there. There's quite a few people that were reaching out to me this week during this crazy market. And, I'm going to try and get back to you with my rules. I can't necessarily say it is the proper thing for you, but please reach out to me and I will tell you exactly how I would treat the situation that you are in. And it's up to you to kind of take that for what it's worth and implement it in your portfolio the way you want to. All right, anyway. You can follow me on Twitter at Wolfman's blog. I've been trying to be a little bit more active on there. And you can follow our parent company at ProTraderStrat. So let's get on with it. How to trade the long strangle. Now, I know you guys can go out online and find out how to do a strangle. Basically, you're buying an out of the money put and an out of the money call, right? It's that simple. Well, not really, because there's a lot of things that go in to this long strangle that can increase your probabilities of success. And I'll go over some of those things here as we go through our steps. But one of the first things that you're going to find online is buying a strangle, and it's just going to say buy an out of the money put and buy an out of the money call. Well, one of my rules is looking for that 30-ish delta. Now, why do we look for that 30-ish delta rather than like a 10 delta? Well, you get the best bang for your buck when you're doing right around this 30-ish delta, if you're going with the strangle. If you go any tighter, you might as well be doing the straddle, which we talked about a couple of weeks ago. So, and then I had a vacation. So sorry for you guys last week that we didn't have a webinar on Friday. And Friday coming up is going to be a holiday, so we're going to do that webinar on Thursday. So make sure you guys have that in your calendars as well. Next week's is going to be on Thursday. But we like to shoot for that 30-ish delta, and I'll go through some of the reasons why. One of the reasons is your probabilities are pretty good with a 30-ish delta, because the probability of that out of the money put, that is a 30 delta, let's just say, is 2 times the probability of it finishing in the money at expiration. So delta tells us, a 30 delta would tell us that at expiration, you know, like today we had well, it was a weekly expiration, but on that expiration day, there is a 30% probability that that stock will finish in the money by 1 penny, okay? But the probability of the market during that option expiration cycle going up and touching that put or that call is 2 times the delta. So there's a 60% probability that the strangle is going to work out by at least going up and touching that put or that call. And, you know, for the lower risk parameter person, that would probably be my recommendation to get out. If it goes up there and just touches that put or touches that call, we've increased in value quite a bit at that point, and it would be the time to cut it out. I've got some other ideas for you guys to look at when we start going through some of the other aspects, but for like a higher risk person to ride this strategy out a little bit longer. Is a strangle the same as a straddle? No, Donna, they're very similar. Where you're buying a put and a call on the long side, you know, I mean, if it's a short put or short strangle, then you're selling both. But the straddle is the same strike at the money for the most part. You can play around with those strikes. I like to build it out as the same strikes at as close to at the money as I can when I'm doing one of those straddles. With the strangle, we're just moving slightly further away, and I'll show you a couple of examples when we pull up the platform, but you're just getting a little further away, and you're going to be paying a lot less in a sense. All right. So essentials of success. Some of you guys have watched these before. You know that these are my steps that I go through when I'm looking for a trading strategy for the underlying. Let's just say we pulled one out of our hat, and I don't know what it might be, but we are going to, when we're looking for the right option, okay, let's just pull up something else right now. Let's just look at Lulu or something. So with Lulu, what we want to do is any stock that is under $100, we want the bid ask to be about 10 cents wide from the bid to the ask. Now, if you're more of a savvy trader and things of that nature, you can kind of stretch out that parameter. One of my things is for the newer traders to just make sure before you really start getting a grasp of pricing of options and things of that nature, to stick with the bid ask on a stock that's under $100 should be 10 cents wide. Now, we are experiencing this year higher than normal volatility, or higher than normal for the last 3 or 4 years anyway. So some of these are getting a little bit wider, especially on these big sell-off days. And on a Friday after the close, everybody canceled their orders. But when you're going through this, just check between the bid and the ask. This is 20 cents wide, so that wouldn't necessarily fit our mantra here. But if you go to the one that is the full month that is closest to expiration, this one's 28 days, and you want the bid ask to be inside of 10 cents like we're seeing with Starbucks here. Okay, that's the first step. Any stock that's over $100, you know, what we're going to do is move the decimal point 3 ticks to the left. So let's, for instance, IWM, we would take the decimal point, move it 3 ticks to the left, and we would say that the bid ask needs to be 15 cents wide now, because the bigger stocks are going to have wider markets. But that's a nice rule of thumb to follow. And as you can see with IWM, it meets that rule. They're a little bit wider than that 10 cents rule, but that's because it's a lot bigger stock. You know, and something like FedEx, we would say move the decimal 3 ticks to the left and say 23 cents is what we're kind of looking for. And you can see with FedEx that fits that parameter. So that's what we're looking for when we're trying to pick the right stock. Now, if you're a savvy trader and you want to go for it, then that's a different story. But one thing to note is make sure when you're looking at most of these as a newer trader, that's one of the first thing you look for. Like Aon or something like that has really wide markets, but everybody knows about Aon. They just don't necessarily trade the options, okay? So one of those things, look at that, move the decimal point 3 ticks to the left on any stock over $100. That's picking the right underlying in that essentials to success. All right, picking the right strikes. Now I kind of blew the doors off on this one really early. We're looking for that 30-ish delta, right? That's where we're going to start looking to build this. Now you can get a little bit tighter, or you play around with that. Maybe you don't have a 30 delta or a 36 delta and it's like a 29 delta. Well, that's what we're looking for. Okay. All right. A couple of questions coming up real quick. Let me see before we get moving. Does the pit hack of 60% touching be slightly less than the 70% out of the money probability? Well, it is different because the 30% or the 30% or the 30 delta, let me say, 30 delta says it's a 30% being in the money, and a 70% is obviously there's a 70% chance that it'll finish at least 1 penny out of the money. What the hack is during the duration of any of these options that we're looking at. Let's just say this. So during this next 28 days on this option expiration cycle, we're going to look for like that 30, 36-ish delta strategy. And, you know, one thing I do say is go further out. Whenever you're buying, you don't want to go inside of like 35, 45 days. So we're going to move it out just a little bit. So these markets here, the deltas over here say that in the next 56 days that FedEx has a 23% probability of finishing, or, you know, in 56 days has a 23% probability of finishing in the money by at least 1 penny. So that would be $250 and 1 penny, right? That's the probability for that happening. The probability during the next 56 days, which is the floor trader hack, is that it is 2 times the delta. So in the next 56 days, there is a 46% probability that FedEx will trade up to 250, at least touch it, and then it might come back off. So for the people with lower risk parameters, and this is a lower probability strategy, so keep that in mind as well, that, you know, you got to just take your money when you've beaten the probabilities. In my eyes, that's beating the probabilities. So when the market comes up, 2 times the delta is your odds of it touching or kissing it, in a sense. Does that answer your question there, John? Is it break even strike plus the cost of the option? Yes, it is at expiration though. So that's one of the big things, is when we're talking about probabilities and things of that nature with options, everything here is at expiration, the risk parameters and stuff like that. So and your break even is really going to be kind of subject to what volatility is doing, Ed, and I'll go over that a little bit in a minute. All right, good to see you, Ted. All right, so let's move on to the next one. So that's picking the right strikes. We're going to start with a 30-ish delta. You know, I probably wouldn't pick this one necessarily. It's pretty close. It's $10 away to the upside. You know, you'd almost rather do the straddle at that point, I think, but we'll have to look at that in further detail when you get that close. All right, so the next one is, so we figured out where our strikes are, the duration. We want that longer duration. So I probably should actually have duration in front of strike, which I'll make that note and fix that, because we need to know our duration before we're picking our strikes, right? Sorry about that. Something I just noticed. Every time I do these, I notice something different, it seems like. All right, so like I said, the reason why anytime we are buying, or I would say 99% of the time when we're paying a premium for a strategy, we want to get out on this flatter sloping curve here, because these are the at-the-money calls and at-the-money puts, the decay of those. This is theta decay. And as you can see, the closer to expiration we get, the closer it's, or the more it starts picking up on its angle of descent. So we're right at 28 days. You can see the next 28 or next 20 days, 21 days, off about 50%, let's call it, 35 days, but 50% of that premium is going to come out. Well, if we bought it, we don't want to see that premium come out, do we? If we buy it, we want slow theta decay. We also want volatility to rise, but that's a different story. But we want slow theta decay. So we want to get further out on the expiration cycle to get that slower theta decay. We also want to give ourselves more time to be right. More things can happen 56 days than, generally speaking, in 28 days. So when you're buying them, move out. Yes, you are going to pay a little bit more for it, but it's worth it for that, slower theta decay and higher probability of something happening within a longer, twice as long of a duration. Okay. The name of the platform, Salvo, is Thinkorswim, TOS. It's through TD Ameritrade. A few of my buddies started it, so I've always been on it. So, and I'm biased towards it because I've grown with it, so I kind of know it very well. So it's one of those things where I just kind of never switched. All right, picking the right environment, you guys. I talked about this. One of the major things that's going to affect this strategy on the long strangle is volatility. And we are in high volatility right now. So it's going to be very difficult to find strategies that we can buy because they are very expensive right now. So picking the right environment, we want an implied volatility percent of below 50. And how do you figure out implied volatility percent? I'm sure some people are asking. Well, one thing is with Thinkorswim, it throws it right down here, current implied volatility percentile. I have the script for our premium members. And then if we want to do it the old-fashioned way, what you do is you have a fraction. You have a numerator and a denominator, right? Numerator's on top of the fraction, denominator's on the bottom. In the numerator, we take the sum of where it's currently trading minus the low, and then divide that sum by the high minus the low. It's that easy. And that will give you a number. That's your percentile of where it is trading now in regards to where it's trading in the past. Now, this is what I was talking about. Last year, you can see every time we had high implied volatility, it was mostly coming in and around the earnings. And for some reason, it seems like it's a little off, but you can see where it's trading right now is higher than its normal highs. Like normally this would be a high 100% implied volatility percent, but now, that's one of the lows of where we're seeing that. So having said that, if we lose volatility and have something like, I think it was AIG was one that has a funky. So if you look at AIG, look at this volatility spike, okay? Is that an anomaly? Well, it seems to be a major anomaly for at least the last year. So one of the other reasons why this math is really important is to discount this, like a diving. You take out the tens when everybody else is getting sixes or given sixes, right? You take out the high and the low. For the most part, that is an anomaly. Mostly the spikes to the upside are the anomaly. To the downside, they are generally not necessarily. But you can see, again, where we are trading now for AIG is about 100%, right, for what it's normally looking at. So I wouldn't necessarily say that this has a low implied volatility percent, but look, it's says it's a 23, but we can look and see it's not really a 23. Okay, so make sure you guys learn that, oh yes, this is paper, this is Salvo's asking paper money, thank you. Yes, this is paper money. One of the things that I cannot do is show you guys actual performance numbers because it's a solicitation and the SEC will be knocking on my door probably. So I can't show performance numbers, quote unquote them. But you guys can follow along and keep track of them if you want. I just can't tell you, give you quantitative numbers, but it's not too hard to figure it out. All right, so, in a sense, we have to be really careful right now in the environment we're at to figure out, double check, throw this implied volatility in there to make sure the numbers we're getting are real numbers, because the likelihood we're going to get that kind of a spike again is probably slim. At least, I shouldn't say that, but it is probably a low probability. Let's say that. Does that sound good? All right, so know that, because if you ever see these, and sometimes there's a break in them, like if you look at the top of my chart here, you'll see NAN. So what that means is that there's a problem with the calculation and the algorithm cannot figure it out sometimes when there's a gap in it. So you're going to need to be able to know that formula in order to figure out what the implied volatility percent is. One thing with TOS, though, it does throw it right there for you. Somehow that part of the algorithm can figure it out, but the other part cannot. All right, or the watch list thing. Okay, so that's really important as well. We want low implied volatility. Why do we want low implied volatility? The lower the implied volatility is for that particular underlying, the less we have to pay for the strategy, and the closer we get to at the money. And I'm going to show you a couple examples here real quick on volatility and how it affects underlyings that are basically trading the same price. But really important to pay attention to that implied volatility percent, and don't just go with the number, especially right now. Double check yourself. Make sure, okay, that one looks like that's a real number, okay? Yeah, it did spike a little bit more during that high implied volatility era, but now we are kind of currently right around there. So I would say that's high implied volatility for BlackBerry. I've never had BlackBerry on here, and I just threw it on there not too long ago because of something with, they're talking with Microsoft, I believe. All right, so we want low implied volatility as we can. The reason why, okay, we're going to look at Nike here. So these, because we are experiencing really high implied volatility right now, it's very difficult to find low implied volatility strategies that will fit the Long Strangle rules that I have, which that's not a bad thing. It just has to do with timing, right? We've planned out like 6 months in advance right now. So I can't tell you when implied volatility is going to be low and when it's going to be high. All I can do is go along with the show, right? Okay, so for instance, Nike at this time, which was a while ago, but we'll just use it as an example. It was trading right around $60, $59.75, as you can see here. So when I did this strategy, an implied volatility percent of 5, which is about as low as it goes, right? 0 is as low as it goes. So it's pretty low implied volatility for itself. So I took the strikes and did the 57.5s in the puts, the 57.5s here, and the 62.5s on the calls. And it was 93 cents for this. So somebody was asking, yes, where are your break evens? The break evens are, you take the strikes and you subtract what you paid for it on the downside. So your break even would have been 57.5. So, with maths, 93 cents. I'm just going to call it $1. So your break even to the downside is, $56.5. To the upside, we did the 62.5 calls. So our break even to the upside is pretty close to 63.5. So that's our break even, right? That we know going into it. But that's at expiration of the underlying. What happens when volatility starts expanding? We started out with really low implied volatility, so the probabilities of implied volatility going up when it's really low are high, right? When it's really high, it's going to want to revert back to the mean. So just like stocks and stuff like that, they have, troughs and spikes, right? So we want to sell volatility on the spike and we want to buy volatility on the trough, all right? So that being said, it's because we're thinking we're going to be riding up the wave to the pinnacle again. So what happens when volatility starts expanding? It went from 5%, we start increasing volatility by just 5%. That purple line here from previous, this is when we start, if nothing else happens, it did trade by 2 cents higher, but volatility, theoretically speaking, if volatility goes up, what happens is we become profitable right away because those premiums start popping. Those premiums start expanding for us. So yes, the break even is at these marks, but that is at expiration. Anything can happen in between and during, and if the market didn't even move, but 2 pennies, but volatility increased by 5%, and it's also not taking away theta decay because I just wanted to show what volatility does to those premiums. And if I put this on when it was trading 59.75 and nothing happened, but volatility started popping by 5%, which isn't a whole lot, you're already profitable. Does that make sense? How that works? Because those premiums go from they were, let's say, 45 cents each when I did those strikes. When I did these strikes on the 57.5 and the 62.5, when I did those, they were probably 45 cents each. They increased by 5%. And now let's say they're trading around 60 cents each. So I've increased the value of my strategy without moving anywhere. Okay. All right. So Farshid's asking a question. Good question too. What are your thoughts on buying a strangle, and probably even a straddle just before earnings announcements? High volatility can go even higher. Yes and no. I would say if you're going to buy this strategy heading into an earnings, I would try and get a month or so in front of it. The likelihood is that it is going to continue to expand, but sometimes it pops up and levels off. The one thing to really take home here is if you are trading this in and around an earnings event, I would say you need to cover this. You better cover this before that earnings announcement, because just the opposite of what happens here when volatility increases. If I were to show you if volatility decreased or just fell out of bed like we see in some of those charts, of course they don't have any earnings, but we can look at Facebook. You can see heading into their earnings, which is what Farshid is saying, you buy this strategy well ahead of earnings, you're going to get implied volatility to start expanding. You can see the market's not going anywhere, but volatility is really popping. And you may be directionally wrong, which when we're doing a long strangle, we need a big directional move generally. That's what we're looking for. We don't know where it's going to go. I don't know if Facebook's going to go up or down, let's say. But I think that there's a lot of, in my thing with Facebook 2 Fridays ago, which was when we did this straddle, it had really low implied volatility, you guys remember? And I was saying this is the straddle we need to be doing because of cryptocurrency. It could make a pop and all this other bad news could make it drop. Well, I don't know which one's going to trump which one, but I think it's going to go in one direction or another. And as you can see, we got a huge move and volatility just blew through the roof. And unfortunately, I didn't do that straddle because I went on vacation 2 minutes after I got off the webinar. So I don't like putting on trades that I'm looking at for these webinars before the webinar, you guys. I wait till Monday so everybody has a chance to get them. All right. I look at them, try and figure out which ones are good, throw them out there. I'm not generally speaking, every once in a while I will if I just can't pass up the opportunity. But it's not that I'm trying to pump and dump it. It's because it's fitting all my rules right now. So, keep that in mind as well. And I didn't do this trade. And believe me, it's been a week straight that I've been really kicking myself. But that's what it is. Look for really low implied volatility. You get this real tight move here. I talk about this a lot of times in my daily market commentaries. When you get that rubber band winding up tighter and tighter and tighter, and the longer it trades sideways like that, the more energy gets built up, and like, boom, it's going to snap one way or the other. Or it could snap like this way, both ways. But that's the idea. Markets want to move, but when they get like this, it's like that's pent up energy in a sense. So that's kind of what I'm looking for. You're not always going to get the volatility to rise when you think you're at a low. It will sometimes, go up and down. So you got to keep that in mind. But when you're way down here, you want to get that expansion and volatility, which is a higher probability than when you're at the middle of the road or at the high end of the road, right? Or high end of the chart. Okay, so we're looking for volatility to expand and a big directional move, right? And then what I want to show you here is we're trading $60, let's call it, for Nike. Now, if we look at an example of Lulu, back when it was trading $61, which was a couple of months ago, keep in mind, but I have tons of charts and I went, or screenshots, so I went through and found a couple of examples here. And it's trading close to $60, let's call it. But its implied volatility percent is a 45, which is inside the mandate of below 50 if we were expecting this volatility to expand at the time, right? But keep in mind, Nike was a 5% implied volatility. Lulu is at around a 45 implied volatility. And if we picked the same strikes that we picked in Nike, which is pretty close, it was trading closer to 60, but you know how hard it is to find two stocks that fit all my rules that are trading exactly 60 or 100 or something like that. It's pretty impossible. And I do try diligently to find that happen. But if we pick the same strikes, it's trading pretty close. We pick the same strikes. Our break evens, as you can see, are way out here at 67 now and way out here at 53. We're still doing the 57.5 puts right here and the 62.5 calls right here. It's trading around the same. The only difference really to make this chart change up is that implied volatility, okay? The duration's the same as well, so I went out in time. This strategy cost $4.75 to pick those same strikes at a 45 IV percent. This Nike trade right here was a 5% and we paid 93 cents. Okay. If we wanted to pay this, we only want to pay 30 or 93 cents for it or somewhere close to it. If I only wanted to pay less than $1, like I did in Nike, the strikes would have to be the 50 puts and the 72.5 calls. And then your break evens are, $1 higher than those strikes or $1 higher than the calls and $1 lower than the puts. But look at this. This gray area is like basically telling you where the one standard deviation move, which is about a 16% probability on either direction. This is about a 5% probability of success because of the high implied volatility. Does that representation help people out there? Like, are you seeing that? Like low implied volatility, seems like a lot less risk than this implied volatility, right? Inside, your break evens are inside easily one standard deviation. Your break evens here are right on one standard deviation for Lulu here. And if we go to try and just pay $1, this is a hope and a prayer. Okay. Doesn't matter which direction the move takes place. No, John, it does not. So we just are looking for a directional move in either direction. Yes, one of those options we bought is going to be worthless. I'm never going to take it off, but the one option that's worthless because it doesn't make any sense to take it off for zero and just let it ride out. But yes, any direction. We want it to go in either direction for profitability. And all of these charts are going to look pretty the same. So once we get outside of those, we become really profitable. But in this regard, you know, we were talking about sometimes people think, well, I got to get to that break even in order to make my money. No, we can sit right here and not have anything happen, but volatility go up. So another thing to note, anytime you're buying premium strategies, you want volatility to go up because those premiums get juicy, right? So now that I've kind of gone over most of the break evens and everything, we're getting ready to go over that again. So, but how do we get out of this trade? When do we get out of this trade? I'm not going to ride this thing into the sunset. I'm going to try and get out of it as fast as I can, to be quite honest, with a strategy where your debit spreads. I like to get out quick because they're low probability. So one thing to think about is 30 to 50% increase in the value of your premium that you paid. So if I paid $1 when it's trading $1.50, I might be looking to get out if that's what I wrote down in my book. And one thing I talk about, and some of you guys probably hear this broken record, but I can't emphasize it enough. Write down all your trades, you guys. Every time you do a trade, write down what the environment was, why you decided to do it. Was it something on the news, something you heard on Twitter or whatever? Write all those things down, or you know, maybe it's a Fibonacci level. And then write your exit strategy down as well. That's more important than probably the rest of it, because your exit strategy is what's going to make or break you guys in the long run. And if you follow the exit that you laid out for yourself, you will be much more profitable. You're going to be more mechanical. And that's what we got to do here, you guys. When we're trading, you have to become very mechanical. You have to somehow set that emotion off to the side. It's not about what you're feeling. It's about the probabilities. And if you guys start trading like I teach with these probabilities, you guys are going to be able to sleep better at night, because you're going to know when I get tested on this strike, what's my probabilities? Well, my probabilities at expiration are this, and my probabilities of touch or the floor trader hack is 2 times that delta. So all of those things are going to make you more mechanical and less emotional. So writing the stuff down, why you got in, why you picked a level to get out, where you're going to get out, will keep you on task. And that's very important. So one way to look at it is a 30 to 50% increase in that value you paid. So $1 would be $1.50 to get out. Or on the loss side, 3 times that credit received. So, you know, I usually lean towards a 50% increase in profit, but 3 times the credit received. So if I paid $1, I would be getting out at $3. Does that make sense? The other way to look at it was the one that I mentioned earlier. As soon as the leg of one leg of the strategy, and a leg is either that call or that put, is breached, then we're looking to cover it, okay, because you've beaten the probabilities. So that's the one. If you have a low risk tolerance, or you're very new to trading options, you're trying to get your feet wet, look at when the strike is touched, you're getting out. It's easy. You don't have to do any math, all right? And another thing is if the underlying is trading near the ex-dividend, you know, if the underlying is trading near those calls, like, you know, it hasn't touched it, but you're just, come on, you know, I need 25 more cents and it's touching my calls. But you're looking there and you're like, ex-dividend is coming up. Cover that trade, because ex-dividend, the idea is the price of that dividend is going to decrease the value of those options by that dividend, or actually it's going to decrease the value of the stock by that dividend, which ultimately is going to affect those the option prices, right? Now, a lot of times it's priced in pretty good, but there are times where the company will come out and not do the 50 cents every single, you know, quarter. Now all of a sudden they do $1. Well, that's going to affect it, all right? So I would rather lean towards caution and get out by that ex-dividend date to get out. So especially if it is looking like it's, getting ready to reach that strike and I'm looking to get out of it, right? If it's down by the puts, who cares, right? We want that stock value to drop by that dividend. So that doesn't really matter. But on the call side, remember, ex-dividend stock is theoretically supposed to drop by the dividend. It doesn't always. Sometimes there's a dollar dividend and it spikes by $2 on that dividend date. So it's just a rule of thumb, but I would, especially if you're a newer trader, get away from that. Let me make sure I got everybody's questions. I think I saw a couple. With volatility going up so much, Facebook dropping like crazy, we would still benefit from this strangle. Yes, if it doesn't bounce, I mean, I would hate to do a strangle right now or a straddle in Facebook, and all of a sudden, I don't know what happens to get rid of the bad name of or the bad stories that Facebook's had. But what I'm saying is, if you get that rebound, we could really see volatility come in quickly, and it's just, to me, it's more of a crapshoot. I think there's better strategies out there for high implied volatility, which high implied volatility is where I make my bread and butter, you guys. I mean, if you guys watch the daily market commentaries, I'm always looking for a collection of credit. But with the volatility where Facebook is right now, there's higher probability strategies. And as a matter of fact, I've been selling calls in Facebook recently. I've talked about in the market commentaries. Doesn't matter. No, so I answered that one. What about Dropbox? It has IPO or it just came off the IPO. Yeah, so there's not options on Dropbox. I'm sure they usually wait like 6 months or something. I think we just started getting Snap. So yeah, Dropbox doesn't. I'm sure I haven't looked, but I do have it up on my thing somewhere. But I bet they don't have. There's your chart. Everybody who got out early, right on the 29, we rallied up in like the first 15 minutes, and then all day it just started dwindling. But you can see there's no options for it yet. They've got to get volatility locked up and all those other things before all that comes together. Credit spreads, right. John, could you talk about, credit spreads, right. Yes, credit spreads for Facebook, yes. And you bought a share, Donna? Did you get the low? I think Dropbox is a good deal, although they're, now everybody's talking about Amazon has something, and if you're a Prime member with Amazon, it's very similar to it, and it's free. I think you get up to 5 gigabytes or something like that. I just read today. I was like, I didn't even know Amazon had something like that, to be quite honest. But good to know now. Anyway, so I was just playing around with some stuff here. So let me go over a couple of other things real quick. Here's another thing, because it is a low probability strategy. I don't know why my computer's freaking out right now, or my charts, or not my charts. My PowerPoint presentation is flipping out right now. It's like underneath and I can't get it. I might have to hold on for a second. Because as you can see, my PowerPoint is bombing right now. Let me try and get this thing pulled back up. All right, here we go. For some reason, it reloaded without. Whoa, you guys don't even understand what I'm going through over here right now. Everything's pulling up. I think I got like 5 different things. That's the strangle. So, all right. Let me try and get this back. Sorry. Nothing like a snafu on a Friday when you guys want to get out of here, right? All right, from the beginning. I'm just going to throw this out from the beginning. And that's the, see, I don't know. Oh, maybe I'm hitting something. I had my elbow on it. Sorry, guys. All right, so, all right, the long strangle. So we know our exit strategy there. Another thing to keep in mind, because it's a low probability strategy. We talked about this, a 50% increase. This is a 50% profit. Well, that I'm talking about increase in profit. Easiest way to do it is times it by 1 point whatever. 1.50 to get that 50% increase. So if I paid $1 times 1.50, it goes up to 1.50, right? If I just did it by 0.5, it's going to drop that, right? So throw that one dot in there to get the increase. All right, but if we're in this strategy for 10 days and I get a 20% increase in it, that's pretty good. I'm going to be really looking to cover that. If I'm in the trade less than 15 days and I have a 30% probability, so basically between 10 and 5, and I have a 30% increase in my profit, that's probably where I'm going to look at it. 25 days at 50, or less than 25 days, and I'm at a 50% increase in profit, cover it. Okay, so that's what I'm trying to do there, because it's a low probability strategy. I'm going to be willing to take less if I get there earlier. The blue screen of death, Farshid, I seriously thought my computer was going to crash. And it has happened before, but I try to do everything beforehand to keep that from happening. Spotify and Uber come off in 2 weeks and would love to know how to get in before the public. Yeah, that's a different thing. Donna, you can reach out to me. I know different ways you can do it, but it's not cheap usually. It's Mercury. Yeah, totally. All right. So now finally, now that we're almost at the end of the webinar, max profit. Anytime you pay a debit for a spread, anytime you pay a debit, that is your, this one, max profit is unlimited because we have no defined risk on it, right? These lines will continue to go up to infinity and beyond, and the puts case, they're going to go to zero, and then that's basically all you get. But at the end of the day, max profit is the unlimited to the upside and limited to it going to zero, which isn't going to happen. Don't hope for that, you guys. Just follow the rules of when to exit the strategy that I talked about here several times. And then your max loss is where I got ahead of myself. Max loss is a premium paid. Anytime you pay a premium, that's your max loss. You know getting into it that your risk parameter is that premium. It's not going to get any worse. But we do have two break evens, and we kind of went over these. Remember, the underlying price is trading equal to the call strike plus the premium paid, or the underlying price is trading equal to the long put minus the premium paid. And all of this break even only comes into effect at expiration, or really after it expires. When it expires, done. It's over. All right. So this is usually where I throw it out. I'm not going to have a whole lot of time to give you guys time to throw out too many, but we're looking for something that has low implied volatility. Throw out some stocks in the questions box there, and I'll go through a couple real quick, and we'll see if we can vet some for some strategies here. I couldn't find anything, to be quite honest, anything that I love for this strategy because of implied volatility right now. And, it's just a little bit wanky. I mean, even when we're looking at Under Armour that has low implied volatility, that doesn't really look that low compared to all these other spikes. So, and since we had a spike here for the earnings that's lower than the spike that we just got here, we can't really take that out of the picture necessarily. We could look at it. But it's going to be pretty cheap. So I'll just look at it real quick until you guys start throwing some things out. Is there a scan on TOS? There is a scan for like IV, the scan that I found, and there might be one out there that I don't know about. I don't do a lot of scans. This is my scan. I just put it over here and throw all the stocks that I usually trade in there. So that's my scan. I go like this. If I want high implied volatility, I go up here and I go, okay, what strategies can I do around these for high implied volatility? And then when I want to do some low volatility or low implied volatility strategies, I come down here. But as you can see, for one, I've lost about a third of my stocks that I used to have in here because I lost my entire watch list one time somehow on all my platforms, all my Thinkorswim platforms. And I lost all my charts. I had to rebuild everything. I don't know what happened. But Anyway, so it looks like it's pretty low. Maybe there's a buyout. You know, I mean, at one point in time when it was trading up a couple of years ago, Under Armour was thinking about buying Lulu. Now Lulu's in a place where they could probably buy Under Armour, and I think that's actually a really good idea for them to do, because I don't think that their men's Lulu stuff does as well as Under Armour's men's stuff. And Under Armour doesn't have women's. Lulu's a little light on men's. Sounds like a good fit to me. But anyway, so let's just say that that's our scenario. We think, hey, you know, it's either going to go bankrupt and nobody's going to wear Under Armour anymore, or maybe it's a buyout candidate. So it could go in either direction. So, you know, for the most part, I'm going to be looking at the 30-ish delta. So we're going to look at the 15, 12 and a half. So I'm going to go buy the 15 calls, and then I'm going to buy the the 12 and a half puts. Okay. So we're paying $1.36 on this strategy, and we'll look at it on the Analyze tab. If my computer will work. I did hit Analyze, didn't I? Analyze trade. Why aren't you working for me? Everything's freezing. Can you guys see that? I don't know what's happening. So thanks for the presentation. Ed's like, oh God, blue screen. His Analyze tab's not working. Toss. I'm not using Toss. Thanks, Ed. But anyway, that's the idea. You guys can go and play with it. I don't know why my computer is freaking out right now, but it doesn't want to give me the Analyze or anything like that. But that's the idea, okay? And play around with it. Know that you need low implied volatility and the expectation that implied volatility is going to expand, right? So don't ever take that thing in one more day after earnings, because that's what happens. And I will tell you, Goldman Sachs will tell you to buy and hold through that earnings event because they're selling it to you. And I even have an article somewhere that has them talking about it. It's just like pretty crazy. But having said that, you want the volatility to expand and a big directional move. We don't want to go through that earnings because you can see what happens to that volatility on earnings. Okay? You guys have any other questions real quick? I think I saw one. So by logical extension, short strangles will be used during high implied volatility percent. Yes, high implied volatility, short strangles, short iron condors, low implied volatility, you look for something that you want to buy. And there's only one time where that whole thing does not come together, and that has to do with the butterflies, like a call butterfly or a put butterfly. And I'll go over the reasons why those don't work out during that webinar. I don't have enough time to do it right now. Yeah, I had a week off, HH, and went skiing in Park City. All right, so guys, shoot, what happened here? Everything didn't remember. That's not the right. Shoot. All right, so this is, sorry, that's not the right one. That's from last week, and I don't know why that's not working out. But this is the deal for this week. I actually have this all in the chat window there. You can just click on the chat window. This is a great deal, you guys. This is how to trade options like the Wolfman. This is a pretty quick and easy thing to digest. There's quite a few webinars in here for 36 bucks. It'll pay for itself. I can assure you of that. I can't guarantee it because I'm not allowed to guarantee anything via SEC rules and regulations. There are no guarantees in life. But protecting your portfolio against rising interest rates. Anybody know what the Fed did Wednesday? They jacked up interest rates. If you don't know what's going to happen to your portfolio with a rising interest rate market, they're going to raise 2 more times supposedly this year, that portfolio is going to get crushed. And I even give a great chart to show every quarter point what happens to the value of that portfolio, because as interest rates go up, the value of that bond or treasury goes down. Yes, if you hold it for 36 years or you hold a century bond for 100 years, yes, you're going to get par back for it. But in the meantime, on average, most people hold bonds for like 7 years. And what happens is, especially right now, people are thinking, I'm going to chase that yield. I want a higher coupon. So I'm going to sell this bond and go buy another one. Well, you can't chase yield. The value of that bond is going to supersede the amount that you can claim higher in your coupon payment. Does that make sense? You can't make up for it. So the only way to do it is to really, one of the only ways, I should say, again, no guarantees, to protect your portfolio, and I go through all of that step by step, and this one video alone will save you $36 in your portfolio. I don't care if you have a $5,000 IRA. You probably have a couple bonds in there or something in there that's going to be affected by interest rates, and that will save you the money there. Also, how to trade gamma. I know a lot of people out there love to trade to gamma scalp and stuff like that. But all of these videos, very important, especially right now. And then it's some fun ones in there with like the history of options. If you ever want to learn about really the very first person, and Socrates even spoke about him in some of his writings, that came up with the first options. He didn't know he was creating options, but he was brilliant. And he did. So basically, if you guys have enjoyed my webinar, you guys really should take advantage of this. Obviously, the best way to become a better trader is to constantly learn, and you guys are taking advantage of that now by taking this webinar. I appreciate that. But continue that education, because the more you know of these options, that means you have more tools at your availability, right? And in the right situations, you're going to be more productive. You're going to have a solid state of mind. You're going to be more conscious. We were talking about being mechanical and getting all that emotion out of there. You're going to be able to put on more strategies. You're going to create more opportunities. And ultimately, you're going to be able to build confidence, which is going to continue to snowball and keep you striving for new opportunities, all right? If you go out there and do this long straddle the first time on an underline and it doesn't work out, don't be discouraged and run away from it, because the probabilities just beat you on that one. So anytime you do that, just say, hey, the probabilities beat me. If you guys were watching at the beginning of earnings season, I was getting beat up, and all I said was, you know what? I'm actually happy. I've lost in the last 3 earnings trades. They came and bit me. Well, what's happened since then? The probabilities have shifted into my favor, and I've been doing very well throughout the earnings season basically over, but I did very well through the rest of the earnings season. And that's it, is don't get discouraged if the probabilities beat you. You just know it's math. The probabilities beat me. I need more opportunities. Okay. So, but take advantage of that. Like I said, if you're watching this on tape delay, you can pause it and go to type this into your URL, or easy enough, it's right there in the chat window. You can just click on that and you will be able to access it that way. It'll just give you a pop-up window. All right. That's all I got for you guys. Other than, I want to thank you guys all. Later webinars, we'll drill down on other option components, when and where I find them appropriate, especially in those daily market commentaries. I hope you guys are taking advantage of those. Also, you can always reach out to me via email for our premium members. Take advantage of that. I know a lot of you guys did this week, and I hope you got a lot out of it. At least you had a lot of kind words to say, so that was a positive, I guess, right? And that's about it. You guys have a great weekend, and if you can't take that, take it easy. JQ, I can always rely on you. Thanks, Andrew. Appreciate it. Take care, everybody. Thanks, Ted. Thank you for kind words. Good to see you, Donna. Take care, everybody.